So thanks to everybody for joining us today for our November edition of WESC webinars. My name is Brittany with WESC, and today I am joined by Bryon Spence, Farm and Small Business Tax Specialist with FBC. Thank you for joining us today, Bryon, and you can please start whenever you're ready.
Perfect. Thank you so much. Same story. If someone could just confirm that everyone can hear me okay in the chat box there, it'd be greatly appreciated. Excellent. Thank you so much. Perfect. So thanks everyone for taking the time to join us today. We're going to go through some top tips for starting your new business and everyone's favorite subject, which is tax. So I'll try to make it as fun and informative as possible. So first of all, just a little bit about who FBC is. It's the company that I work with. FBC has been around 66 years. We started in 1952, originally with farms, and we've expanded out into all types of other businesses as well. We're a tax technology leader, so we were one of the first companies to actually use software and computers to actually process tax returns and file them. And now we've moved into the AI and app space as well. We're Canada's only year-round membership model. So what that means is rather than the traditional approach where you bring your affairs to your accountant after the year is over and hope they do the best with them, we work with you throughout the year. So by the time the year end rolls around, you're in the best tax position you can be in. And nationwide, we have 300 highly trained and motivated staff with a single focus, which is also incidentally our motto, which is to make your life less taxing. Excellent. So let's get started. So what is the definition of a small business? So it's important to note that CRA considers a business something that is an activity where there's a reasonable expectation of profit. So keeping clear and current records is an expectation of CRA if you're running a small business. So some of the things we're going to cover, setting up, keeping good records, and being aware of what can trigger an audit. So audits are an unfortunate reality of being a business owner. So we'll go through some of the triggers that cause them in the first place. So starting out with setting up, you're going to have to choose a business structure. Now, you have three choices in Canada of what type of structure you'd like to use. You've got a sole proprietorship, a partnership, or of course a corporation. And when should you register for GST? So let's start with the first and most simple form of business structure. That's going to be a sole proprietorship. So sole proprietorship is essentially the most simple to set up and most simple to run from an administrative standpoint, but there are some advantages and disadvantages. So they're easy to form, there's fewer regulations, there's stronger potential to access capital if you are a strong candidate for getting financing. So if you've got good credit yourself or you've got existing resources through friends and family, then the business is essentially you. So if you're a sole proprietorship, you are the business. And for that reason, you're also going to be taxed at individual tax return rates. So the more you make after expenses, the more you're going to pay in taxes because taxes are marginal. Now, some downsides, unlimited liability. So the problem with a sole proprietorship is that you're the business. If you get yourself into business trouble or you get sued, your personal assets are actually at risk because everything is combined in a sole proprietorship structure. Limited life, because you are the business. If you pass away, the business ends at that stage. And there are also going to be increased difficulty raising capital because it's all on you, because you are the person that is asking for the financing or asking for the asset. Your own personal credit worthiness is a factor. So if you have poor credit coming into your own business, that's going to be a factor in your ease of raising capital or getting financing. So the next would be a partnership. Now, the easiest way to imagine a partnership is you're looking at two sole proprietorships that are operating in tandem. So you've got, or if you've got, and you can have more than one partner, you can have several partners in a partnership. Similar to a sole proprietorship, they're simple to form, simple to dissolve. There's lower startup costs than an incorporated entity. Again, the ownership of all profits. So whatever your split is, if you've got a 50-50 partnership, each partner would then take 50% of the profits. Fewer regulations than a corporation, individual tax returns and tax rates. So again, depending on where you end up at the end of the year, you'll be taxed as if you'd made that money. The easiest way to look at it, so let's imagine you worked a T4 job and you earned $75,000. Whatever your tax bill would be there, that's exactly how you'll be taxed as a partnership after your expenses are accounted for, of course. So whatever your after expense net income is, you'll be taxed exactly as if you'd made that money working for someone else. So the downsides, unlimited liability, again, because you are the business, you or your partners are the business, the liability is unlimited. You can be sued, or your personal assets can be at risk. Limited life, again, if one partner decides to leave the partnership, one partner passes away, the partnership will cease to exist at that point. You'll have to restructure. And of course, the biggest challenge with a partnership is the possibility of disputes and conflicts. This is probably one of the largest reasons we see partnerships dissolving, is because one partner just starts to have a different philosophy of how the business should be run or how the day-to-day should operate than another, and it causes a rift that ultimately ends in the partnership dissolving altogether. So those are the two most basic forms. Now you've got incorporation. Now, when is a good idea to incorporate? Well, first, let's explain exactly what a corporation is. Where the first two structures, you are the business, or you and your partners are the business. Corporation's different. You're actually creating a legal person separate from you. It's kind of interesting. You've created a legal person with rights, that has rights just like we do, and it's treated separately as an individual. And it is all for that reason, there is a separation of your own assets and whatever the corporation. So you can almost imagine the corporation, and you lend Susie all the assets, or you give her assets that she will need to start the corporation, and then all the profits and expenses then run through her. So your shares in the company, so you'll issue shares. So let's say you have 100 shares total. As long as you have 51 or more of those shares, or 51% or more of those shares, you have all the say in what Josie the corporation does. So it's important to look at it as a different type of structure entirely than a proprietorship or a partnership. So it is the best structure to use in Canada, I would say, bar none, but there are downsides to do it. So mostly the downsides come to cost. It's going to cost you more money to use a corporate structure, because again, this person that you've created actually has to do their own tax return in addition to yours, which you'll still have to do. And there's also so there's the cost, there's the extra admin, there is some hassle involved in using a corporate structure. So you just want to make sure the pros outweigh the cons. So some rules of thumb that make sense when looking at this is the business generating profits in excess of personal spending requirements? So if you're making $150,000 and spending $151,000 every year, you're really not going to see the advantages of the tax advantages of a corporation, because you're spending all the money that's coming in. When the tax benefits of a corporate structure outweigh the extra costs and admin of using the structure, it's a good time to start looking at it. And when you desire greater flexibility on the exit of the business. So again, because you've created this person separate from you, if you as a shareholder pass away, the business doesn't necessarily cease to exist. It continues on without you. So again, when the income is greater than the need, so let's say same example, you've got $150,000 of income, but you only need $75,000 to live. That is a great example of when a corporate structure would be very good to use, because you can leave the remaining profit in the corporation. It's taxed at some of the lowest rates in Canada, and then it's available to you personally when you do require it. You can pull it out at that time. So limited liability, extended life, income control, potential for tax deferral, income splitting. So if you've got more than one shareholder, you can actually split the income that does come in. So again, you could say $150,000 of income, I only need 100 of it, and I'll split that evenly between two partners. So it can be very tax efficient when it comes to how to operate. Small business tax deduction, potential for increased business. When people see that you're incorporated, they tend to take you a little bit more seriously. They can see that you've got skin in the game. You're interested in developing this business to a higher degree. So there's a potential for increased business from that standpoint. And business name protection, you can register the name of the corporation and then it is protected. You can also use a numbered company. A lot of times people will start with a numbered company and then choose to name it something afterwards. Now, downsides, again, expensive. It's going to be more money. You're going to pay more for your accounting. You've got additional schedules and returns to file, increased paperwork, no personal tax credits, less tax flexibility than a proprietorship or a partnership. The liability may not be completely limited. So although it's considered, that's the reason they call it LTD, it was limited liability. Although a lot of times your liability is limited. It's not completely limited. So if you do something negligent, and they can prove that, for example, your business does something and somebody gets hurt, and they can prove that you as a director had a part in that, you can be personally held liable. So it's not a complete insulation from liability, but it's much better than the other two structures. And closing is more difficult. You can't, unlike a proprietorship, you can't just stop operating. You need to dissolve the corporation. You need to roll the assets out of the corporation. There's things that you need to do in order to close a company that aren't as simple as the other two structures. So that's just a basic overview of the different structures that you have available to you as a business. Now, when should you register for GST? So if you provide taxable goods or services in Canada and you have revenue in excess of $30,000, now $30,000 in four consecutive calendar quarters, as soon as you hit that threshold, you should register for GST. And there's advantages to it as well, because although you'll be collecting GST on behalf of the government, then you can also claim what costs went into your business that you paid GST on against that. So essentially what you do is you collect GST and you claim what you've paid GST that went into your business against it, and you send the government the difference. Now, if you have under $30,000, you can still claim GST as an expense under your income tax, but you won't file for it separately as you would if you have a GST number. So let's talk about keeping good records. Keeping good records helps you avoid CRA fines, ensures you collect the money that is owed to you, and better helps you understand your operation and helps you get back to work sooner in the event of an audit. So although the CRA requires you to keep records, they are beneficial for more than just your taxes. It gives you an idea of what's going on in your business. What are the trends in your business? Are there particular times of the year where your income is greater than others? It also gives you an understanding of where your money is going. Hey, after looking at this, I can see that I'm spending a heck of a lot more in this area of my business than I realized. And maybe there's a way that I can cut back and further improve my cash flow and my bottom line of my business. So it's really important that you keep good records from a requirement standpoint, because CRA requires you to do so, but there's also a business advantage as well. So as far as good record keeping, if you're doing it consistently, it saves time when filing your taxes. Your records are ready to go for your accountant for year end. Helps you again identify sales trends. Improves the odds of securing capital or the fair sale price of your business itself, because if you've got good records, it shows that you're credit worthy, or if you're looking to sell, that you can show this is why I can justify the price that I'm asking. Awareness of spending ratio to income, as I mentioned before. If your spending is way out of whack with your incomes, it gives you an opportunity to address that. Clear picture of your financial health, and of course, if you're audited, your records are going to be key, and we'll chat about that in a minute. So as far as your requirements with the CRA, you are required to keep your records for 6 years from the last notice of assessment, which ends up being about 7 years worth of records. So it's probably where you've heard that 7-year figure from. My recommendation to everyone is just keep 10 full years of records. Beyond that, you're safe to dispose of the receipts and the tax returns, that type of thing. But within that 10 years, it's a good idea to keep it just in case you need it. You have to keep them paper ledger or electronic bookkeeping software. So what does that mean? It means you either have to be physically writing down all the different expenses that you had in their totals, or you can keep it electronic bookkeeping, which is of course far easier. Now you must keep the original receipts or digital copies of the original receipts. Now, what I mean by that is, for example, if you take a client out to, let's say you take them to the Cactus Club and you get an itemized receipt, you pay with Visa, you get an itemized receipt, and you get a Visa slip. You actually have to keep the itemized receipt. The Visa slip is not enough because it doesn't show what the transaction comprised of, and showing them your bank statement saying, here, you can see that I went to Earl's at this day and this time, that's also not good enough. You need to show them the actual receipt from the transaction, because they need to be able to see what actually happened within that spend. Now, you can keep digital copies, so you can actually take a picture of the receipt and dispose of the original if you want, but you do have to have a copy of that original receipt. Also, too, if we're using that example of a restaurant, it might be a good idea to keep the Visa slip as well, because then you can claim the tip portion of the expense also, which won't be on the detailed receipt. All right, so let's go through some record keeping tips. Number 1, keep records clear and current. It's very easy to procrastinate records. They're not everyone's favorite thing to do. So it's best to kind of keep a consistent monthly or weekly practice of keeping your books up to date. Another thing that you can do is, what I like to recommend is, spend 30 minutes once a month, take all your receipts out of all of where they may have ended up in your car or your shoe box or your glove box, and just put them in an accordion folder and keep them neatly organized. And that way, if you're doing that consistently throughout the year, then it doesn't become a daunting task at the end of the year to go through all those records. Now, as far as software is concerned, there's several different pieces of software available to you. Some benefits of using it: ease of data entry, the information is accurate and it's easily available, easily accessible and shareable. So if you're working with an accountant, you can easily share your record keeping software with them or access to it. Simplifies tax compliance, and management tools are available. So for example, for clients of FBC, we have a software package called Cashew. It does a couple things. First of all, it takes away the need for data entry, because it'll actually download all the transactions from your bank statements for you and categorize them for you. So then, instead of going in and actually entering all that data once a month, you're actually just going through and making sure the software did it correctly. And also, it can show you trends. So for example, when we're talking earlier about expenses being out of whack, you can see, what are my spends in each different area, and are they reasonable for my size of business and income? By all means, Cashew is certainly not the only software out there. There's many different ones. A lot of people are using QuickBooks or Simply Accounting. There's all kinds of different packages out there. So my recommendation, look at a few and see what works best for your budget and your skill set, because some are easier to use and more user-friendly than others. So let's talk about available deductions. So the good news is, the bad news is there's over 3,500 pages of tax law. The good news is largely they're in your favor. You just have to know what they are. Unfortunately, not everyone has time to go through 3,500 pages of tax law. So that's why you have tax professionals. So what kind of deductions are available to you? So a system really isn't enough. You need to know what you can claim. So we'll talk about that. Separate accounts for business and personal. That helps you simplify tracking, keeping all your receipts or bills. And of course, one thing that's always worth mentioning is keeping close track on cash deposits or withdrawals. So if you're doing anything that's cash-based, it's difficult to track what that is unless you keep note of it. So it's important to pay extra attention to those. So available tax deduction: meals and entertainment, equipment, office rent, supplies. It's not an exhaustive list by any stretch. What makes your business unique? So I always give people the example: if you feel that you had to spend that money and it had a reasonable effect on your ability to earn an income for the business, there's a good chance that you could probably expense it. So even if it seems a little bit unusual, if you can imagine yourself sitting across from an auditor and they're asking, well, why do you think that this is a reasonable expense? And if you think that conversation would go reasonably well, here's why I think, and here's how it affected my business, and here's how it helped. There's a good chance that, it's a good thing to include. The worst case scenario, they will disallow it. And a lot of people are missing out on a lot of expenses that they could be taking advantage of just because they don't realize that they're eligible. So I always give people this example. If you were to imagine all these receipts, these annoying receipts you have to look after throughout the year, actually have a dollar value to you at the end of the year, they become a little bit more encouraging to look after. So in this case, you've got a Staples receipt for $50, which is going to result in $20 less in tax this individual is going to have to pay at the end of the year. So when it comes to meals and entertainment, don't forget the 50% rule. So let's imagine that situation with the Cactus Club. You're taking out your client. So they're only going to allow you don't have to worry about the 50%, but whoever is preparing your taxes has to worry about it. You're only going to be able to claim 50% of that total expense. And the reason for that is CRA basically says, if you're out with somebody, we're going to allow you to expense their portion, but we're not going to allow you to expense your portion. You would have had to eat anyway. You could have gone home and had a sandwich, but you chose to eat with your client at the Cactus Club, so we'll let you expense half of that. Now, if you are doing meals and entertainment as part of your business expenses, which I would recommend anywhere you can legitimately make that claim, you are also supposed to keep a tax journal. So you're supposed to keep a journal of who you met, when, what was discussed, and most people, frankly, don't have one of these journals. I usually, when I'm in front of a room of people, I'll ask, show of hands, anybody have this? And maybe 1% to 2% of the room puts their hands up. And also, incidentally, it tends to be the people who've been through an audit. So what you can do to accomplish the same objective, rather than keeping a tax journal, is just take that receipt, flip it over, and write on the back of the receipt who you met with and what was discussed. And depending on your business, it can be fairly easy to make most meetings a business meeting. You can ask, for example, if you're a realtor, hey, are you looking to buy or sell property? Well, no, I'm not. Okay, well, thanks for letting me know. Either way, you can't win every client that you or potential client you sit down with, but at that point, business has been discussed and you could legitimately expense that meal. Business use of home. Now, this is always one that gets a lot of questions. If you are a newer business, oftentimes you'll be operating out of your home. So you want to make sure that you're taking advantage of the business use of home eligible expenses. So things like utilities, property tax, house insurance, repairs, mortgage interest. Now, I want to be specific here, just the interest. You cannot expense the principal portion, but you can expense the interest. So you will designate an area of your home to be your home office or business use area. So the way it works is, if you imagine you had 1,000 square feet of space and 200 square feet of that is going to be used for business, then you would take 20% of all these expenses, so utilities, property tax, house insurance, etc. So a lot of times people either aren't claiming home office at all, or they're underclaiming. They're using a very low number that frankly could be a little bit more aggressive. So it's certainly worth taking a look at what's available to you there. Now, same way you're supposed to keep a log of your meals and entertainment expense, you are supposed to keep a log in your vehicle. So if you're using a vehicle for business, you should be keeping a log of all business use of that vehicle. So most people, again, don't have this. They don't have, the pen and paper logbook in their glove box, but what they do have in a lot of cases is a smartphone, and a smartphone will do a better job and a more accurate job than you could ever hope to do pen and paper. So just to give you some challenges with not keeping any sort of logbook, let's say, for example, you've got a vehicle that you're claiming 70% for business and you are not keeping a logbook. It's one of the first things that CRA looks for in the event of an audit. They say, okay, what's your logbook? Well, I don't have one. Okay, well, we're going to have to look into that. So if you don't have a logbook, which you're required to keep, you are at their mercy. They could choose to disallow your vehicle expenses altogether, or they could come up with a significantly lower figure than you have. So let's say you had 70, they could say, well, we'll give you 40. And without a logbook, it's very difficult to defend that. So what an app will do for you. So for example, this is Milecatcher. There's lots of other apps out there. So choose whichever one you feel is best for you. But what they'll do is essentially they will sense when you're driving. You don't have to tell it. It'll say, well, this person's probably not running 50 kilometers an hour. They're probably driving. So it starts to track. And then when you stop, and this is the case of Milecatcher, other ones are a little different. It just asks, hey, was that a business trip or a personal trip? And you just let it know. And if it was business, it'll keep a running total of all your vehicle expenses for your vehicle expenses for your business. So again, it makes it a little easier for you. You don't have to think about it as much. Most of these apps do have a cost associated with them, but they're a business expense. So of course you can claim that as well. So promotional costs. So you want to get the name out there about your business. So things like advertising, business cards, promo material, in some cases donations, and I'll get to this in a second. These are things that you can and should be engaging in and expensing as part of your the promotion of your business. Actually, what I'll do, I'll come back to that one just for a second. So when it comes to donations, let's say, I'll give you an example. So let's say you have a son or daughter that is on a sports team and they've asked, hey, would you be so kind as to support the team? And we'll put your business name on our jersey, or, maybe behind the backstop at a baseball diamond, that type of thing. So in those cases, as long as you can justify that the business receives some sort of promotional benefit by the donation, then you can actually claim it as a promotional cost, or promotional expense, which is better than if it was a charitable, because you're going to get 100% of the deduction versus a portion of it. So if you do go ahead and do that, just make sure you keep some sort of proof or evidence that the business benefited in some way. So whether it be a flyer, a picture of a jersey or something. So if you're ever questioned on it, you can show, hey, yes, here is the name my name on the jersey. Of course, that was seen at every game, every season game. And we got some exposure as a result. Keeping business and personal accounts separate. Now, you can have a business and personal account, which I would recommend if you're a business owner, but also what you can do if you don't have separate accounts, You can even just take a credit card and designate this credit card is for business. So I know that everything on this card is business related. So a couple good things there. Makes bookkeeping a whole lot easier because you know that everything on that statement is business related. So you're not having to pick out any personal expenses. But another few things that are great about doing that. Number one, if you get a points bearing card and you go to Jamaica on points that you earned for money, money you spent through your business anyway, that's not currently a taxable benefit. So that's one thing. Now, if you do have a points bearing card, there's probably going to be an annual fee associated with it. Typically, when there's points or some sort of benefit to the card, there's also an annual fee that goes with it. Now, if everything on that card is business related, you can now expense that annual fee. And finally, if you end up carrying a balance from one month to the next, and again, everything on there is business related, you can expense that interest. If you start mixing personal expenses in there, it becomes too difficult to determine what was business and what was personal. So those are some additional advantages of going that route. So knowing about startup costs. So, there are costs, of course, with starting up the business itself. And we'll go through a little bit of that now. So claiming expenses after the startup date. So the business start date is the date that significant activity that is part of earning income starts. So when you decide to start a business, you may make some initial expenditures with that purpose in mind. However, it's necessary to establish whether the expenditure preceded the start of the business or whether the business had in fact begun when the expenses were incurred. So the date the business started can be said to have commenced or started
sound just when you started talking about the startup costs.
Oh, can everybody hear me? Looks like I got kicked off there. Oh, perfect. Okay. Excellent. Sorry about that. Okay, so when it comes to startup, of course, whatever the calendar year that falls in, you'll have your expenses and incomes in that year. You'll claim it at the end of the year. So these are all the expenses I had. And really the first year that you're in business, you'll probably have quite a few more expenses just in the startup phase. So you want to make sure that you claim them all. And even if you have a loss, sometimes you can carry them forward to the following year. If you're incorporated, of course, it's important to choose a date of incorporation if you want to have everything fall into that corporation that you choose to incorporate before you really start to spend money or make money. And that way you can have all of that income and expense go through your corporate entity. Because that is the one thing I didn't mention with a corporation. If you are a proprietorship or a partnership, you're essentially going to be a December 31st year end. There's very few exceptions to that, changing that date. Whereas with a corporation, you can choose any date you want. So some people choose to have a corporation just for that reason, because they can have the busiest part of their year fall at a certain time, so they can structure their business year end accordingly. So bringing personal assets into the business. So if capital assets are acquired for a business before the business commenced and are later used in the business and are not used for some other purpose in the meantime, the capital cost of the assets is the amount that it would have been had the business been operating when the assets were acquired. So if you're operating a sole proprietorship, this is a reasonably simple process. So the Income Tax Act requires that you transfer these assets to the business at their fair market value. So that means they consider you to have sold the assets at a price equal to their fair market value at that time. So if this amount is greater than your original purchase price, you actually have to report the difference as a capital gain on your income tax and benefit return. So essentially, if you're bringing assets that you already own into the corporation or into your business as a proprietorship, you need to value what they're worth at the time you bring them in. and then you can have that be part of your, there's what's called a capital cost allowance or CCA schedule. These are all the assets within my business, and what the CRA allows you to do, and this will include vehicles, by the way. So what they can do is say, okay, this is what this asset was worth on January 1st, 2020. And then they'll allow you to depreciate that asset at a specific rate, and it's dependent on what type of asset it is. So a vehicle will be different than a computer. And what the government's allowing you to say is this asset is worth less by a certain amount every year. So for example, with a vehicle, you'll start out with, let's say, $10,000, and the government allows vehicles to be depreciated at 30% a year. So that vehicle, in theory, will be worth $3,000 less after the 1 year than it was when you purchased it, or when it was rolled into the business. All right, so keeping receipts organized. As I mentioned before, that best practice, once a month, just take those receipts, put them in an accordion folder, have them ready for whenever you may need them, and also know when to get help. So that's the other thing. When you start out a business, it's going to be really tempting to save money and try to do a lot of this yourself. And that's a good idea to start there and just, okay, I'm getting the business started. You should be able to at least do your basic books and be able to, when you do hire a professional, have a competent conversation with them about it. So you don't want to necessarily outsource everything immediately right away. You should have at least a cursory understanding of most elements of your business. But there is a time that'll come where it's not worth your while to do the bookkeeping anymore. It's not worth your while to do invoicing anymore. You can have somebody do these things for you, because ultimately your time has a value to the business. So let's say, for example, when it comes to hiring a bookkeeper, at some point, the time away from your business, sitting there doing books or record keeping or invoicing, is going to cost your business more than having somebody else do it for you. So you just really want to determine, is this still worth my while to be doing this activity, or is it better to outsource this? So we mentioned audits earlier. So let's talk about 6 audit triggers that unfortunately get the unwanted attention of Canada Revenue Agency. So some facts, some non-financial facts about audits. 61.6 hours is the average amount of time that business owners spend just complying with CRA auditors. So that's just giving them what they need, answering their questions, going through the process, which leads to an average of 9.8 days of lost productivity. So I often imagine you go through an audit and it turned out neutral. You didn't owe them anything. They didn't owe you anything. It was a neutral outcome. But you lost 9.8 days of productivity in the busiest part of your year. Might that have a financial impact on your business? So $12.6 billion also is spent by small business every year just on tax compliance. So dealing with a CRA is a big thing. 28.2% of small businesses have been audited in the last 3 years, and those audits resulted in an additional $8.3 billion in additional payments to the CRA. So audits aren't going away. It's a big revenue generator for the government. So, audits are here to stay. So what can you do to avoid them? They're an inevitability, but what types of things can you do to avoid them? What gets their attention? So seems obvious. First one would be not filing your tax return on time. So what you want to do to the best of your ability is get your tax return in by the due date. Now, I will say this, you want to have a return that is as accurate as possible. You don't want to just throw in a tax return you know to be incorrect just to get it in by the due date. You want to put yourself in a position where you can get it in as accurately as possible and on time. If you know you're going to be late, and you owe something, another good practice is just to pay the CRA what you think you owe them, because at least then you're not going to be penalized on the whole amount of owing just what the difference is. So give it an example of that. Let's say you actually ended up owing them $10,000, but you didn't get them your tax return in on time, and you sent them $9,000 ahead of time. And then by the time you file, it turns out you owe $10,000. So you underpaid them by $1,000. Well, now you're only going to get a penalty and interest on the $1,000, not the whole $10,000. So, again, best thing to do would be to put yourself in a position where that tax return is in on time. But if it's not, at least pay them what you think you owe them or what you can, so that you'll reduce those tax penalties later. Not providing information when requested. So typically when CRA asks you for something, they'll give you a period of time in which to comply. Usually it's 30 days. So they'll ask, we want to see some expenses relating to this item, or we want to see your moving expenses, your receipts for that. Again, usually it's 30 days. So what you don't want to do, because I assure you it will come at the absolute worst time for you. It'll come in the middle of a busy season, or something else will be going on in your life. So if it's something you can't comply with in that 30 days, just ask them. Call them up and say, hey, it's so-and-so. I've been asked to provide this documentation. I'm happy to do so, but I'm going to need a little bit more time. And just ask for what you need. And almost always they'll grant you that additional time, but you do have to ask for it before the due date. So you don't want to put that envelope at the bottom of the stack and hope it goes away. It's not going away. So you just want to make sure that you give yourself enough time to deal with it. Claiming a consistent loss, kind of as a rule of thumb, the CRA enjoys money coming in one direction. So I wouldn't recommend somebody leave legitimate losses on the table because they're worried about getting the attention of CRA. Just be aware, if you're consistently losing money from one year to the next, and there's reasons why that might be, and if they're legitimate, by all means claim them. But if it's a consistent thing, at some point the CRA is going to say, well, what's going on with this person? Why don't they seem to be earning any income? Let's take a closer look. High expenses against limited income. Again, if your expenses are way out of whack with what's standard in your industry and standard in your geographical region, they're going to want to know why that is. So again, if you have an abnormally high expense year, but they happen for a reason, something, you had to build a structure, or you had a disaster and you had to buy a whole bunch more material, whatever the case may be, your expenses may be high against a lower income for whatever reason. Again, if it's legitimate, claim it, but just be aware in those types of situations, there's a higher likelihood that you'll be looked at a little bit more closely. And finally, significant difference in annual revenue. Now, the CRA knows that business is cyclical and that income is going to fluctuate from one year to the next. However, they'll take a look at where your business stacks up with others in the similar industry and in your geographical region. So let's imagine that you are a realtor in Saskatoon. They're going to know that here's how you stack up against other realtors in Saskatoon, and they'll kind of have a band of what's average. So the market goes up, the market goes down. People fall somewhere along this band. If someone is way up, way above it or way below it, they'll say, well, why is this person so far out of what everybody else in the area is doing? And again, they'll look at it regionally too. So they're not going to compare a realtor in Saskatoon to a realtor in Vancouver. It's not a realistic comparison. So they will look at and take into account where the business is located. So just a little bit about FBC. We have the four pillars of service that we offer. So we've got planning, preparation, consultation, and protection. So the very first thing we do with any of our clients was to take a look at the last 3 to 5 years worth of their taxes, just to see what's been done, and then sit down with them and do a tax plan. So say, great, here's the good and the bad of what's happened up till this point. What can we do from today forward to make sure you're in the best position you can be in moving forward? We also look at things like exit, retirement, and estate planning. Preparation. We're unique in this sense. We come to meet with you at your place of business or home, and it doesn't have to be during business hours. If you'd like to meet with us after hours or on the weekend, we can accommodate that. GST, PST returns, bookkeeping, annual financial statements, etc. Consultation with us is unlimited, so you can call us as often as you want. There's no extra charge for it. We don't charge you by the phone call or by the visit. You'll have a dedicated business professional to work with. Protection, finally, if you are audited as a client of FBC's, your responsibility is to give us the name and number of the auditor. We do all the back and forth with them. If they want to ask you any questions, we're also going to physically be there with you as well, so that you're not saying anything to get yourself in trouble. And finally, we do stand behind our work. So if an error by us results in a penalty being assessed, we'll reimburse the amount of the penalty. So we are human, we make mistakes, but we also put it in writing and we make it right. So a couple things that we'd like to offer everyone on the call here today. We have a free ebook, 10 Strategies for a Profitable Business. So you can head over to fbc.ca/webinar to register for that and get yourself a copy there. Also, too, if you are new with the business and you'd like to sit down, even if you've got an established business, you'd like to sit down and have a conversation with somebody about anything you may have heard on this webinar. If you have any other questions or concerns, we'd like to offer a free consultation. So what that looks like is just reach out to us at one of the numbers, or either register for the ebook or head on over to our website, get in touch with us. We will offer you a free, no obligation sit down. We'll go through with some questions with you, see where things are at with the business, and let you know at the end of that, either we can help or we can't. And if we're not able to, we'll just point you in the right direction. So feel free to take advantage of that. And also, too, for members of WESC, If you do decide to work with us, we will also include for the first year, normally $399 visit, a pre-year-end tax planning visit where we'll actually go through your entire tax year before the year is over, tell you what your tax bill is going to be if your year was to end that day, and then find out what we can do between now and the end of the year to lower that bill. So again, that'll be included at no additional charge for just as an appreciation for taking the time to spend with us today. So does anybody, while I've got people on the call, does anyone have any questions right now? I see 2 questions being asked. I see typing happening. Okay. So the slide on when business starts versus expenses. So the entire presentation was recorded, so you can watch the replay if any part of it you weren't able to catch. We'll have it all there as well. In the meantime, while Colleen is typing a question here, so essentially the slide in question about when you start your business. So depending on the structure that you're using, I'll just get into this a little bit. Depending on the structure that you're using, you just want to make sure that you start incurring expenses ideally in the year that you're going to start business. So let's say, for example, you want to start a business this year and you have several assets to purchase or expenses to incur in order to offset that income. You ideally want to start that process when you actually have, or when you intend to, in short order, earn some income. So let's say, for example, you're considering it right now, we're middle of November, and you're considering starting a business in the next couple of months, but you're not overly tied down to a date. At this time, if you can wait, or you've got contracts that might come in the next couple of months, it might be a good idea to wait till January to start that. Although if you do start it now, you will have an extra business tax return to file the end of this year, even though it'll be a stub year. You only have a couple months of business to report. But if you start in 2019, you will have to report business income and expenses in that year as well. Now, if you have a corporation, again, you'll want to time the start of that corporation to when you actually start wanting to start doing business. A lot of times what we'll see is someone who started a corporation 2 years ago and they filed 2 years worth of zero returns because they never got the business off the ground. And then when they actually do start, they just had that unnecessary expense of doing those zero tax returns and the administrative hassle. So to the best of your ability, you want to kind of have an idea of when you want to get the business started and structure that you're going to use, and then plan accordingly. Colleen was asking, so does time work towards the business count as proof of start if revenue is slow to follow? They had a 10-month lag. So absolutely. I mean, if you've spent the income and you spent the money and the income didn't come right away, but again, the spirit of the spend was to earn that income, by all means, I would include it for sure. Another question, do you advise on setting up a new business, including permit requirements? Absolutely, we do. So if somebody's considering getting into business, they want to make sure they're doing everything correct right from the get-go. By all means, reach out to us. We'll have a consultation with you, show you some things you need to be considering. But of course, the consultation is at no charge. What if you do work for an organization that issues honoraria versus a paid quote? So that one you want to make sure that you have some advice on, because if the business isn't necessarily paying you, you want to make sure that if you are claiming the income, it's kind of income in kind. So, for example, if they've given you work or an asset of a particular value, they're giving you a cash equivalent of something, you want to make sure that you're valuing that appropriately and claiming for it appropriately. All right, looks like we've got one more question. Then what I'll do as well, I will, as I mentioned, please do reach out. We'd be happy to answer in as many questions as you have. And if you have something that you didn't want to ask in front of the group here, we would be happy to sit down with you one-on-one. Oh, all right. That question has now disappeared. Well, I just want to thank you all for your time today. Appreciate the opportunity to speak to you. And again, if you have questions, reach out. And I hope you have a fantastic remainder of your day and week. And have a great week.
I also want to say thank you to everyone that was able to join us today. You'll be able to view the webinar on demand on our website within a few days. And our next upcoming webinar is how to get more clients using social media. It'll be on December 11th from 12 to 1 and presented by Katrina German. So bye everyone and have a great afternoon.